Good morning or afternoon again. My name is Joshua Scott, a senior associate on the membership team here at the GIIN, and also have been very intimately involved with the GIIN Initiative for Institutional Impact Investment. As I just mentioned a few moments ago, we're hosting this webinar today with the GIIN research team to bring to you some data from their recently released financial performance brief. I just wanted to kick things off really quick with some housekeeping items, and I'll hand it over to my colleagues to sort of run us through the content of today's webinar. First of all, we have everyone on mute. That way we don't have any interference during the presentation. If you would like to submit questions, which we encourage you to do, you can find a chat option in the bottom left-hand corner of your screen. You can use that to connect directly with us here at the GIIN to submit questions. If you could please, if they're general, state so, or if they're directed at one of the presenters today, please state that as well so we can direct them towards the right person. That would be fantastic. In addition to that, just to keep in mind that we are recording today's conversation so we can use it for future perpetuity. And I think that wraps up everything in terms of housekeeping items. So what I will do now is hand it over to my colleague, Abhilash Mudliar, who is the director of our research team, to give us some introductory thoughts. Abhilash?
Great, thank you, Josh. Welcome, everyone. We're excited to host this webinar focused on the topic of financial performance and impact investing. I'll just kick things off with a few introductory remarks before passing it on to the presenters for today. In recent years, as institutional investors and others have begun to explore opportunities in impact investing, one barrier to entry has revolved around questions about the ability of impact investments to generate competitive and strong financial returns. And so to this end, we believe that transparency around financial performance is important for several reasons. One, it helps investors set well-informed performance expectations. It also allows investors to better benchmark their financial performance, enables investors to make more informed portfolio allocation decisions, and of course it enables new players to enter the market more confidently. And part of the role that the GIIN plays in building the impact investing market is in providing resources that fill important and critical knowledge gaps in this developing industry. Specifically on financial performance, we have a number of initiatives underway to increase the level of transparency and the availability of data. Firstly, our initiative for institutional impact investment will be creating a library of financial performance research which aims to provide institutional investors and funds the evidence necessary to make the case for impact investments. The goal of the initiative overall is to remove key bottlenecks common to institutions engaging in the market. We also produce our own research. In recent years, in partnership with Cambridge Associates, we've developed benchmarks of financial performance in the private equity and real assets asset classes. And in early 2018, we'll also be releasing a study on the financial performance of private debt funds in partnership with Symbiotics. Our most recent report on this topic synthesizes findings across over a dozen studies on the financial performance of impact investments to glean broader insights for the market as well as to reinforce its growing credibility. And so on this webinar, you'll firstly hear key findings from this new report. And then you'll hear reactions from our guest investor speakers, Anna, Harold, and Sylvia, about this research. They'll discuss the implications for the industry, as well as key considerations in developing a balanced portfolio. Ultimately, we hope that this conversation is the first of many on the growing body of financial performance data for impact investments. And we invite you to participate in several ways. First, by submitting your data for our research. Second, by joining the GIIN's Initiative for Institutional Impact Investment. And last but not least, by adding your data to our resource library. All of these efforts are critical for broader industry development, and so we thank you for your contributions. At the end of this webinar, Josh will provide more details on how you can participate in these various areas going forward. With that, I will now pass it over to my colleague Rachel Bass to begin the presentation.
Great, thanks, Abhilash. So as Abhilash mentioned, there has long been this barrier to insight into the financial performance of impact investments, which has prevented the attraction of new capital and more capital into impact investing. And so the GIIN, along with many other research, has prioritized this as an area of focus. And in recent years, we've seen a number of studies that have emerged that shed light on financial performance of different segments in the impact investing universe. And so we've taken the findings from these and synthesized them into the report pictured here, GIIN Perspectives, Evidence in the Financial Performance of Impact Investments. And so today, I'll start by walking through a few of the key findings on 3 asset classes: private equity, private debt, and real assets. And then we'll have a discussion among some impact investors to hear their perspectives on the implications of these findings. So we'll feature thoughts from Anna Kens from Grassroots Capital Management, Harold Wakate from Aegon, and Sylvia Panecki from WestPath Benefits and Investments. And then, of course, we'll take time for audience questions. So as a reminder, please submit any questions that you may have through the dialog box on the lower left-hand corner of your window. As many of you know, impact investing is an approach to investing that can be applied across asset classes. However, from our annual surveys, we know that to date, most impact investing has been concentrated in private capital markets, specifically private equity, private debt, and real assets. And so unsurprisingly, most research to date has focused on these 3 asset classes and will ground us in the conversation we have today. We also know from our research that impact investors target a range of returns from concessionary to market rate. About 2/3 of investors principally seek risk-adjusted market rates of return, and the remaining third principally focused on deliberately targeting below market rate returns. But given the proliferation of activity on the market rate end of the spectrum, most research to date has focused on that segment of the market. And so I'll take you today through some key findings and research in these 3 asset classes, one by one. Of course, I will note that financial performance is one side of the equation, the other being, of course, impact. But today we'll focus on the finance side of things. So let's start with private equity. There have been 3 major studies to date that look at private equity financial performance in impact investing. The first was produced through a partnership between the GIIN and Cambridge Associates, which sought to develop a private equity benchmark. The most recent updates to the study featured findings from 71 funds investing worldwide, with vintage years from 1998 to 2014. And this update found that these funds generated a net return of 5.8% per annum to their investors. The second study, shown here in blue, was produced by the Wharton Business School and analyzed the performance of 170 transactions made by 32 market rate vehicles, again with a global focus. And this study found that those investments generated an average gross IRR of 9.2% per annum. And more recently, McKinsey & Company analyzed the performance of 51 exits in the Indian social enterprise market, which found an average gross IRR of 11% per annum. Overall, these numbers are pretty consistent with each other, since McKinsey looks at exits only, and the Wharton study looks at both exits and unrealized investments. Meanwhile, Cambridge and GIIN look at returns net of fees and expenses. So once we take all of those different considerations into account, the end findings are quite comparable. Of course, it's useful to then take a deeper look at the Cambridge GIIN benchmark in particular, since that assesses net fund returns, ultimately what investors really care about. So the graph here shows the quartile distribution of individual fund returns from the 71 funds in the Cambridge GIIN benchmark. On the far left is the overall performance across all of the funds in the benchmark, and then we've then segmented it out by a couple of different characteristics. Let's start with that left bar. Just to walk a little bit more through what we're looking at, the light blue box is the third quartile, the navy blue is the second quartile, and the whiskers on either side range from the top 5% to the bottom 95th% of the funds in performance. And so what do we see here? The first observation is that while the overall average is 5.8%, individual fund returns vary widely. Top-performing funds generate over 20% per annum, while poor-performing funds generate negative returns. And this is the same in conventional investing, demonstrating that in impact investing, just as in conventional private equity, fund manager selection is really key to success. The second thing to note is that if you put a quartile distribution of conventional private equity next to this impact distribution, it would look almost identical. We actually did this comparison in the original report that came out 2 years ago, and it showed that both impact and conventional universes, roughly 2/3 of funds generated positive returns, and about 1/3 generated negative. We also broke out the data by fund size and target geography. Fund size is the second and third bar from the left, and then target geography is the two on the far right. And an interesting finding here is that funds under $100 million in market cap performed at least as well as the larger funds. And there's often the perception in conventional private equity that large funds necessarily outperform smaller ones. And so it's encouraging to see that's not necessarily the case in impact investing. So now we can turn to private debt. And there's two reports that I'll reference. The first was produced by Impact Investing Australia, in the blue here, which looked at 54 private debt transactions in the Australian market and found an average growth yield of 7.9%. The second was produced by Symbiotics, which analyzed the financial performance of microfinance investment vehicles, or MIVs, around the world, and it has been doing so for about 10 years now. In the most recent study, which came out earlier this year and looked at 93 MIVs, Symbiotics found an average growth yield of 6.9%. They've also calculated expenses and hence net returns, which is shown in the graph on the right, which varied from 1.4% to 4.5% depending on currency and whether or not the fund is leveraged. So lastly, let's look at real assets. Here again, the GIIN worked with Cambridge Associates to develop some benchmarks for this asset class. And specifically, we focused on 3 different strategies: timber, real estate, and infrastructure. And so again in this graph, the light blue box represents the third quartile, the navy is the second quartile, and the whiskers on either end show the full range from the 5th to the 95th percentile. What we see is more or less the same picture as we saw with private equity, in that individual fund returns vary significantly, and the top performers generate strong double-digit returns, while poor performers are generating negative returns. The median and the average are both within the single digits across the board. In this case, we've also prepared comparable universes that we can compare to our impact benchmarks, looking at timber, real estate, and infrastructure again. And so these are shown on the right of the impact benchmarks in each of these 3 segments. As you can see, they're more or less identical. Again, this tells us that for impact investors that are seeking market rate returns, achieving those returns is feasible, but again, depends on fund manager selection. As with the private equity benchmark, these benchmarks are going to be updated by Cambridge Associates on a quarterly basis going forward, and so we're aiming to deepen the data set continuously over time and be able to track trends. And so I'll leave you with these 3 takeaways from across the studies. I won't repeat them since I've mentioned them a couple of times already, but I do want to just pull them out and highlight them for a moment here. Of course, there's a lot more information available in the full report, which can be accessed through the GIIN's Knowledge Center and downloaded freely. And I'll just reemphasize that these studies are the first of their kind. we're hoping to see more and to continue to advance transparency in the market. And so I just encourage everyone on the line to submit your data to researchers and participate in these field-building efforts going forward so that we can continue to grow the evidence base and strengthen the case for impact investing. Now I'll just turn it over to the first of our three speakers who can share her perspective on the implications of these data. Anna Kens from Grassroots Capital Management.
Thank you, Rachel, and thank you all for joining this discussion. My name is Anna Kans, and I'm the COO of Grassroots Capital Management. Grassroots exists to strengthen communities and help alleviate poverty. We advise and co-manage impact funds that mobilize investors' capital to support institutions that aim to contribute to a more just and sustainable world. A large portion of our investments has been in the microfinance sector, given its demonstrated potential to scale. While establishing commercial track record is very important to us, at the same time, we have been early and vocal advocates of a more comprehensive appreciation of value to encompass a more inclusive set of stakeholders. In late 2003, what is now Grassroots helped to launch the Grey Ghost Microfinance Fund, a pioneering private fund of funds intended to promote the microfinance industry and in particular, private capital flows into the industry. At the time, it was the largest private investor in microfinance. Next slide, please. So what you see here is realized company-level performance for 33 microfinance institutions that we invested in. And this shows that there's ample evidence from both our portfolio and other investors that investments in microfinance institutions can yield very competitive financial returns. The majority of these exits yielded annualized returns in excess of 20%. So this has helped engender strong interest from both impact and conventional investors in microfinance and other impact sectors. Next slide, please. However, this doesn't tell the whole story. Results at the individual company level don't always translate into results at the portfolio level. On this slide, there's a comprehensive snapshot of the early vintage of microfinance-focused equity funds, which largely avoids selection or survivor bias because it includes all of the funds that we know about of that vintage. The data suggests that there are some costs to being a first mover. Trial and error finding successful business models, stabilizing and safeguarding the balance between financial and impact objectives, accommodating structures and timelines that may erode financial returns, and innovating and absorbing the higher costs and failures that will inevitably accompany efforts to address challenges of poverty, exclusion, economic justice, climate change, and other adverse environmental effects. So we're seeing this, we saw this in microfinance, which now is a bit of a more advanced sector, and we're seeing in other sectors as well. Next slide, please. The GIIN research adds to the growing body of data on impact investing, which is needed to enable the impact industry to realize its potential and attract the necessary capital to address the social and environmental issues. However, limiting the conversation to financial returns discounts the critical role that impact funds, and especially equity funds, play in enabling emerging sectors to evolve from very narrow products to investments that are accessible and appropriate to the wider capital market. Including both financial and non-financial bottom lines in the same conversation is essential to the investment proposition and enabling investors to make more informed investment decisions. Rachel mentioned that this research was only part of the overall research being conducted, and we look forward to the upcoming research on the equally important non-financial bottom line. And with that, I'll pass it on to Harold.
Thanks, Anna. Just before we get going, Harold, just wanted to remind everyone on the line that we've received a bunch of questions already, but just wanted to reiterate that you can submit those questions in the bottom left-hand corner of your screen. Sorry for jumping in there, Harold. I'll hand it over to you now.
Okay, thanks, Josh and others for having me in the call, and thanks also for this report. Very important research that GIIN is doing, and it's an important contribution to the discussion about impact investments. So a quick introduction to Aegon. Aegon is primarily an insurance and pensions company. I'm with Aegon Asset Management, which is the asset management investment division. So we do investments on behalf of the insurance companies in the group, but also on behalf of external clients like pension funds. Our total assets under management are approximately $700 billion, and about $8 billion of that we count as impact investments, and it's done across a number of asset classes and sectors, as you can see on the slide. So the focus areas for us in terms of impact themes are affordable housing, clean energy, health, and poverty alleviation, certainly also linked to microfinance. We have the next slide, please. So in terms of financial performance, this is a very important component for us in our investment decision making. So we're one of those finance first investors. Again, looking at the insurance companies and pension funds that we make investments for, they tend to be liability driven investors, and so it's very important that they make investments that actually meet their investment criteria to cover those liabilities. So again, financial performance is a very important indicator when we make decisions, and we're always looking at whatever available data to figure out what the financial performance of our investments has been in the past, and obviously what it might be in the future. But I think it probably goes without saying that financial performance is but one indicator, and obviously goes hand in hand with risk factors, and that is also something that we tend to look at very closely. And like with financial performance, not always easy to find metrics that give a good picture of what the risks of certain investments are. And then, of course, we also look at a lot of other factors besides financial performance and risk. Scale being a very important one, and we see that in this area, impact investments, often there tend to be very small investments. And I saw on the slides that looking at funds, that's not necessarily an indicator of poor financial performance, but for us, it's more also a consideration of investment management. So if you make a small number of large investments, they're much easier to manage and to monitor than a very large number of smaller investments. So that's an important consideration for us. Liquidity tends to be very important. Sometimes we have a preference for more liquid investments, sometimes for less liquid or illiquid investments, also depending on the asset class and the type of client, but that tends to be an important part of the discussion. And I included competition here, so that's primarily what we see in the clean energy sector. That tends to be an important consideration, especially if we're participating in auctions. How many others are participating? What's the likelihood of us actually winning an auction and being able to make an investment at still an attractive price? And finally, also internal expertise, very important, because we do need to have people who can select the investments and monitor them. And so we also find that can be a consideration. So next slide, please. So in terms of the role that impact investments play in our portfolio, it varies a lot, also because we have very different types of clients. So it tends to be whatever role the client would like it to play. But here we see many considerations. Again, obviously, impact itself and sustainability considerations can be very important, but here again, it varies client by client. Some clients are more interested in these aspects than others. And so what we tend to see most is that clients approach this from an asset liability matching point of view, especially with things like microfinance diversification or correlation can be an important consideration. We do a lot of investing in tax credits, especially for affordable housing, so the extent to which the client has tax liabilities is an important driver. And government backing can be very important, especially we're a large fixed income investor, and we have a specific preference for investing in bonds that are somehow guaranteed or backed by governments or government agencies. So with that, I think I'll wrap up for now and hand over to the next speaker, and then happy to answer any questions later on.
Thanks, Harold. Just a reminder again to continue submitting questions to the dialog box. I'll now hand it over to Sylvia Pinecki to present next. Sylvia?
Thank you, Josh. Hello, everyone. My name is Sylvia Pinecki, and I am the Director of the Positive Social Purpose Lending Program at WestPath Benefits and Investments. WestPath is a $23 billion asset owner managing retirement and benefits assets for over 100,000 active and retired clergy and lay people of the United Methodist Church. As a sustainable investor, we are actively involved in shareholder advocacy, proxy voting, portfolio screenings, as well as community investing. Our investments are made according to values that create a healthy financial bottom line, as well as positive social and environmental impacts on society. Our impact investments are spread across both debt and equity strategies and currently total approximately $3.1 million and focus on affordable housing and community development, microfinance, low carbon solutions, so energy access, renewable infrastructure, sustainable agriculture, as well as women and minority business enterprises. WestPath remains the largest denominational investor in affordable housing programs for low and moderate income families in the nation, thanks to our positive social purpose lending program, which I head. And we have cumulatively allocated approximately $2 billion to affordable housing and community development investments through this strategy. We have also, through the program since 2005, invested approximately $83 million in microfinance initiatives in developing markets around the world. Next slide, please. Financial performance is just one of several prerequisites that factor into our decision-making process related to investment selection. We evaluate a variety of components when considering an opportunity, including the strategy itself, the team, the focus, philosophy, performance, alignment with our values. As a pension fund, our investment decisions are driven by fiduciary obligations to our participants and clients. And then as far as our impact activity goes, we have a very strong 27-year impact and performance track record that supports the notion that you can have a positive impact on society and the environment while earning a risk-adjusted market rate of return. Next slide, please. So we continue to work on identifying impact themes that we have growing expertise in and which we think will be drivers of a sustainable economy. As a faith-based organization, we are mission-driven and our investment decisions align with church principles. As a fiduciary, we aim to invest in opportunities across asset classes that generate market rates of return while having a measurable positive impact on society and the environment. As far as the GIIN goes, we very much appreciate all the initiatives that they are taking in terms of focusing on impact investing, and we are very much agreeable with the takeaways that they've kind of provided some insight on in terms of this report. So very much appreciate what you do, and it definitely helps us in being able to report on the impact investments that we've done over time. So that ends my piece of the presentation. Thank you.
Thank you so much, Sylvia. And also thank you again to Anna and Harold for giving those brief thoughts on their own portfolios as well as experience with the use of financial performance research within their respective portfolios. What we'll do now is move over to a Q&A period. As I've mentioned a couple times throughout the call, we've been receiving questions from all of you and have collated those into a list, and we'll try to get to all of them. But if we are unable to get to your question in particular, we'll make sure to follow up with the respective speakers individually and get that to you in due course. The first question we have here, Harold, is for you. We've talked a lot about this call, sort of like the financial drivers for, in investing with an impact. And, you mentioned a couple of times one of the other key considerations that you look at is sort of like investment risk. And so just out of curiosity, this participant wanted to know, what are the main drivers of risk within your portfolio? And how do you manage them?
Well, that's a very tough question, because the overall portfolio for Aegon as a group is about 700 billion, which is it's very fragmented across many asset classes, across many countries and sectors. So, I'm not sure I can answer that. I think the biggest component in the portfolio is fixed income investments, corporate credit, as well as sovereign bonds. So there, obviously, the main drivers of risk are just the creditworthiness, interest rates. So that maybe answers the question in part.
Yeah. What about within the impact portfolio in particular? Maybe that's like a little bit more narrowed down.
Yeah, well, I think the same applies there, because also in our impact portfolio we're exposed to different types of asset classes. I think you really have to drill down to individual sectors. So I think microfinance is probably a good example. So there, at the end of the day, the main risk or risks are country risk. So obviously, we're invested in microfinance funds that have exposure to a lot of emerging markets. So probably altogether about 100 different markets where political risk can be a very important driver. And then also just sort of the default risk for individual microfinance institutions or MFIs is an important driver of risk.
One quick follow-up on that. How do you see that comparably? Maybe not within microfinance, but within sort of your other impact investments, in terms of different types of risks that you would look at versus a, say, traditional investment as compared to like an impact investment, or is it practically the same?
Yeah, I think they're very comparable at the end of the day. So looking at clean energy, for example, so obviously there are specific risks related to wind investments or solar investments. So with wind, obviously a large risk is if the assets don't perform as well as the wind studies suggest that they will, or if they turn out to be built in the wrong place. But otherwise, I think the risks are very similar to investments in other kinds of real assets or liquid assets. So again, you're looking at things like who's running the company or the project, what's the quality of management, what's the quality of risk management, what's their track record, and so forth. So overall, I would say the risks are pretty similar for impact investments compared to, let's say, mainstream investments.
Yeah, I think that's a point that we hear a lot through our discussions with sort of new institutional investors entering the space, is perceived difference in risk, which there are obviously other considerations that one needs to take into account when entering impact. But generally, as you mentioned, Harold, those risks seem to be quite similar across different asset classes between sort of the quote-unquote mainstream and impact. And just wanted to give Anna and Sylvia maybe a chance to respond to that question as well, sort of like where you see the main risk drivers coming from in your portfolio, and if they compare in your mind to, maybe this is more for Sylvia, the more traditional assets within your portfolio. But Anna, did you want to take a crack at that question?
Sure. I mean, I'll let Sylvia handle the bulk of it, since we are 100% impact fund managers, so we don't have the more traditional investments. But I mean, I think the size and track record are probably more risky in impact investments as they tend to be earlier stage potentially. Also, all of our investments are in emerging markets, which bring their own risks that Harold mentioned, political risk, repatriation risk, other regulatory risks. Not to say that in all cases they'll be more risky, but those are some of the things that might differ from more traditional investments in developed markets.
Yeah, and this is Sylvia, and I would just echo what Harold and Anna have already said. I agree that the country and political risk are definitely kind of the front runners in terms of things we look at, but in terms of just we treat all of the investments and the process that we select the investments the same, regardless of whether it's impact focused or not. So everything is treated equally in terms of selection and then making sure that it's a sound investment that we're making. So not really going to add anything additional. I agree with what Anna and Harold have already stated.
Thanks, everyone. And another question we had also goes back to sort of the financial performance piece, but looks at different areas of impact and how that compares across different areas of impact, if it is different at all. And so the question that came in from a participant, and maybe we'll start, Anna, with yourself, is how do you differentiate different types of impact, and are these correlated with different return expectations?
Yeah, that's a good question. I mean, I think this sort of goes back to setting expectations and having very clear objectives at the start of the investment. So both for, as a fund manager, both when you're designing and launching the fund and marketing it to investors, and then also when you're making your investment decisions, making sure that your impact objectives are aligned throughout, and that you don't have to have the same impact objectives for every investment or across investments, but having that transparency and having that the clear objectives from the outset allows you to measure and monitor performance and then course correct throughout the length of the investment. And that has helped us also in terms of managing our own impact expectations and also just seeing where additional support is needed, either through technical assistance, or we're also active in governance of our investments, our equity investments, and so where more support might be needed in terms of oversight and board participation. So it's really more about being clear about the objectives from the outset and then monitoring and managing expectations throughout the investment.
Sylvia, did you want to respond to that as well, sort of the different impact themes that you mentioned that WestPath covers? Do you see, or are you sort of expecting different types of return, and whether they're correlated with those different types of themes?
We are. So we have our impact investments, as I mentioned, are spread across a number of different strategies and investment buckets. So the return expectations will have to match or kind of meet up the requirements of a given fund that impact investment is placed in. So that definitely drives kind of our selection and the sizing of the investment itself. And then, again, let me see. I'm sorry, I lost my train of thought here. And so, between, say, an equity play versus a debt play, obviously there are different return expectations associated. And so that is something that is kind of built into the overall evaluation of the strategy, and just making sure that, given that we're a long-term investor, that there's different benchmarks that are met over time based on the structure of that given deal.
Thanks, Sylvia. And Harold, I'll give you a chance to respond to that as well. I'd be interested to hear, across again, Sylvia, like the different impact themes that you mentioned in your presentation, what your expectations are, and the correlation between that with the impact theme.
Yeah, so our approach is pretty similar to what Sylvia just described for WestPath. So I would echo that. So we again, look at specific investment criteria by specific asset classes or sectors, and then whatever we find in terms of impact investments will need to meet the same requirements, those same requirements as any other investment. So not much to add to what was already said.
Thanks, Harold. Sylvia, this question for you in particular, this is sort of I think an interesting perspective. Granted that we're discussing sort of the financial performance of, impact investments in all sides of that. Have you seen any, losses, and what kind of losses have you seen over the time in your impact investment portfolio?
Sure. So this is specific to the positive social purpose lending program, given that we've been in the space of community development and affordable housing investment through that program for over 27 years. We've been able to monitor very closely the performance over time and just kind of the impact over time. On over $2 billion that we've invested over the 27-year period, we've seen very minimal losses, accounting for about 5 basis points on that $2 billion. So it's pretty impressive. That's largely due to just the oversight of the program itself, and then also the different players within that space and the guarantees that are in place for those investments. We've definitely seen a very low loss rate and a lot of success in the oversight of the program and just the performance. So always very happy to kind of speak to that, just because it again proves that, you can make that investment, have an impact on society, and still kind of come back and come off very well over the long term with the low loss rates in that space.
Yeah, thanks, Sylvia, for that. I think that's an extremely important point to make, as we discussed the point that, market rate, risk-adjusted market returns are very much achievable with an impact, recognizing different types of capital as well and the different aspects and risks involved in getting involved in impact is very important in addition to that. So our next question from participant is actually directed towards Rachel regarding the findings in the study, and the question is, what kinds of impact areas and impact themes did the PE funds in that benchmark cover? So I'll hand it over to Rachel for that.
Yeah, so the greatest number of funds in the private equity benchmark were invested in multiple different industries, multiple sectors, with a focus on financial services. But we heard others that were invested in business services, information technology, and consumer and retail. And so the impact themes they were targeting reflect the different sector focuses: access to basic services, access to finance, and job creation, and sort of other things that are reflected in these sectors.
Thanks, Rachel. Our next question is maybe directed towards just Harold and Sylvia. And I think it's interesting because one of the key components of the Initiative for Institutional Impact Investment will be a set of case studies that we are undertaking, looking at the different types of ways that different institutional funds have gone about setting up an impact investing practice internally. And this question in particular was covered in those case studies. And, I thought it would be interesting to maybe bring it up here on the call. I know Harold and Sylvia, you've both taken part in an interview for that. Harold, your case study has just been released, and Sylvia, yours will be forthcoming. But how and what sort of barriers to getting involved in impact did you find internally, sort of when you were trying to make the case? And I'm assuming that financial performance might have been one of them. And maybe Harold, you want to take the first crack at that question?
Yeah, sure. We've certainly run into barriers. I think it's not so much like what often people think that when we work with our portfolio managers and analysts that they're somehow opposed to this idea of impact investment. It's typically we find that they're actually quite curious about it and happy to contribute to it, but it's often that they're just not quite sure how. And so that's also, I think, what my role is and my team's role is to support them with exploring opportunities in whatever their specific focus area might be. So whether it's private equity or private debt or asset-backed securities. And I think what tends to work best is just to come up with very sort of tailor-made solutions, saying, okay, if you're investing in this particular area, you might think about one or more of these types of investments that we would consider impact investments. And then often what we find helps is if we can do some really structured work around it to solve a lot of the technical questions that typically tend to come up. And then obviously financial performance can be one of them. But it's certainly not limited to performance, and as I've mentioned, a lot of the other considerations. And often, an important barrier is just time and resources, because people are typically happy to look into these things. But if you really want to do it well, it can be sort of a labor-intensive process. So if we can help with the relevant resources, then that typically solves a lot of problems for the people who actually need to make the investments.
Thanks, Harold. And Sylvia, did you want to respond to that as well, sort of, the barriers that you faced internally? I know being a faith-based organization, you sort of have it in your DNA, but I'm sure in sort of approaching some of these new types of asset classes, and not necessarily asset classes, but themes and sectors, there might have been a little bit of pushback as well on how you addressed that.
Yeah, I think that the biggest hurdle has, always, and it's kind of constant, is just the fact that, people don't want to give up returns just because you're making an investment in the impact space. And so over time, we've been hopefully proving that to our investors who are actually very supportive of our initiatives in the impact space. They actually want to see more. Some of the hurdles that we've kind of encountered more recently is just kind of the market and, our ability to be competitive from a pricing perspective, when compared to other lenders in the space. And so that kind of prohibits us from maybe doing as much as we want to at a certain time. But again, we're long-term investors, so we kind of are able to wait out during periods that may not be as feasible in terms of making new investments. I think the other piece is just, as Harold mentioned, is just the expertise and just the manpower overall, just having enough staffing, so that there is a confidence that we have evaluated every initiative appropriately and fully. And then branching out into kind of the new themes, that always kind of comes with its own challenges, just because, again, we don't have maybe as much expertise in that space. And so there does require some time to kind of build up that expertise and comfort, both internally and externally. And so, we've definitely strived to do that as well. And part of that includes kind of adding to our team and just making sure that the staff members that we do have are doing the research and making sure that they're fully kind of equipped to handle making the decisions, on these new themes. So that's just a few things.
those are all things that we've heard echoed across some of the other institutional funds that we've spoken with throughout the initiative. So thank you both for contributing on that. And Anna, on the flip side, do you find that your investors have realistic expectations of financial performance? And, are there examples when you necessarily haven't been aligned?
Yeah, that's a great question. I think, research like the GIIN's research and the growing body of data on returns and as we've sort of built out our own track record has helped align expectations more. But in the beginning, definitely when there wasn't really as much data, I think it was just, and even now that there is more data, it's just really important to be upfront, as I mentioned before, about what is possible to be achieved, and investors also, for them to be upfront about their return expectations and be realistic about what those expectations would then require at the company level in terms of responsible growth, in terms of the right internal controls and the right resources to achieve that growth responsibly. So it's kind of a continuum of helping investors set realistic expectations by letting them know what those expectations sort of translate to at the company level and at the fund level.
Hey, thanks so much for all those insights. And I think we'll take the last few moments here to just wrap things up and tie together some of the comments that my colleagues Rachel and Abhilash mentioned at the beginning of the call. As I mentioned as well, we were excited to host this call today as it was sort of a collaboration between two pieces of the GIIN's strategy team, one being the GIIN research team, as well as our new GIIN initiative for institutional impact investment. We encourage anyone, and we know there were a couple questions that we didn't get to today, which we'll be happy to follow up with individually. But if you have any additional questions, you'll have Rachel and my contact details from the email that we sent around this morning with the slides. Encourage you also to share that with colleagues internally. If you indeed also are trying to make the case for impact within your own organization, encourage you to do that and reach out to us in ways that we might be able to help. Some of the resources that Abhilash mentioned at the beginning of the call, I'll reiterate now. The first being the fact that we encourage you all to submit your research and data on the financial performance of impact investments to us. There are two ways that we'll be able to utilize that information. One being the Library of Performance Research that the Initiative for Institutional Impact Investment will be launching in the first quarter of next year. The anchor piece of that library will be this GIIN Perspectives report on the evidence of financial performance of impact investments. But in addition to sort of having that resource of the library available to you, we'll also be able to use any data that you have on the performance of impact investments to update the different benchmarks that Rachel and Abhilash mentioned throughout today's conversation, and as well as ongoing update to the financial performance brief, which was the basis for today's call. In addition, if you have any clients and or peers that are interested in joining the Initiative for Institutional Impact Investment, I encourage you to reach out to me. You can do so through my email address. There's a brief survey that I'll send over for you to fill out to sort of get you involved in the group. I've mentioned another of the resources that we'll be rolling out this quarter and ongoing, which are example case studies of how institutional investors have gone about making the case for and building out an impact investing unit within their organization. Some of the topics which we obviously covered over today's call, so hope this was extremely useful for you all. And in addition to that, sort of having covered the financial performance aspect of impact investments, we also recognize that there's also the impact measurement and management aspect of impact investing. And we'll be having webinars focused on that aspect of the impact market in January, and more information on that will be forthcoming, but happy to field any questions on that as well. So with that, I'll wrap things up. Want to thank our speakers again on today's call, Anna Kantz, Harold Alcalta, and Sylvia Pinecki. I'm sure you all will join me in giving them a big round of thanks, and want to thank you all again for dialing in today. We really appreciated your participation, and this, as I mentioned at the beginning of the call, will be available as a recording. So if you have any peers or colleagues that would like to listen in, please reach out to us and let us know. And with that, I will wish you a great rest of your day, whether it be just getting started or at the end of it, and look forward to interacting with you all again soon. Thanks again.